In finance, a straddle is an investment strategy involving the purchase or sale of particular option derivatives that allows the holder to profit based on how much the price of the underlying security moves, regardless of the direction of price movement. The purchase of particular option derivatives is known as a long straddle, while the sale of the option derivatives is known as a short straddle. Long straddle. A long straddle involves going long, that is, purchasing both a call option and a put option on some stock, interest rate, index or other underlying. The two options are bought at the same strike price and expire at the same time. The owner of a long straddle makes a profit if the underlying price moves a long way from the strike price either above or below. Thus, an investor may take a long straddle position if he thinks the market is highly volatile, but does not know in which direction it is going to move. This position is a limited risk, since the most a purchaser may lose is the cost of both options. At the same time, there is unlimited profit potential. For example, Company XYZ is set to release its quarterly financial results in 2 weeks. A trader believes that the release of these results will cause a large movement in the price of XYZ stock, but does not know whether the price will go up or down. He can enter into a long straddle, where he gets a profit no matter which way the price of XYZ stock moves, if the price changes enough either way. If the price goes up enough, he uses the call option and ignores the put option. If the price goes down, he uses the put option and ignores the call option. If the price does not change enough, he loses money, up to the total amount paid for the two options. The risk is limited by the total premium paid for the options, as opposed to the short straddle where the risk is virtually unlimited. If the stock is sufficiently volatile and option duration is long, the trader could profit from both options. This would require the stock to move both below the put option strike price and above the call option strike price at different times before the expiry date. Short straddle. A short straddle is a non-directional options trading strategy that involves simultaneously selling a put and a call of the same underlying security, strike price and expiration date. The profit is limited to the premium received from the sale of put and call. The risk is virtually unlimited as large moves of the underlying security's price either up or down will cause losses proportional to the magnitude of the price move. A maximum profit upon expiration is achieved if the underlying security trades exactly at the strike price of the straddle. In that case both puts and calls comprising the straddle expire worthless, allowing straddle owner to keep full credit received as their profit. This strategy is called non-directional, because the short straddle profits when the underlying security changes little in price before the expiration of the straddle. The short straddle can also be classified as a credit spread because the sale of the short straddle results in a credit of the premiums of the put and call. A short straddle position is highly risky, because the potential loss is unlimited due to the sale of the call and the put options which expose the investor to unlimited losses or losses equal to the strike price, whereas profitability is limited to the premium gained by the initial sale of the options. The collar is a more conservative opposite that limits gains and losses. References: General, Macmillan, Lawrence G. Options is a strategic investment. New York and New York Institute of Finance. ISBN A978-0-7352-0197-2. Macmillan, Lawrence G. Options is a strategic investment. Prentice Hall Press. ISBN A978-0-7352-0465-2. Specific.